Hello, everyone. Today on the Final Bar, we will wrap this week, and it is a week that needs wrapped. We will talk about the market rolling over on Thursday, really exploding to the downside on Friday. Sort of that initial gap lower after the CPI number for the open today, chopping around, regaining a little bit, but the last half hour really pushing the S&P to new lows, settling in around 3,900. What does this mean for the big picture? It's not bullish, ladies and gentlemen. This is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of stock charts, using the technical analysis toolkit, the data visualization techniques we have available to us to better quantify investor behavior, better understand investor psychology, and try to figure out where things are headed overall. I often talk about the market in multiple time frames. And a day like today, a week like this really starts to rotate the short-term time frame back to negative. My market trend model as of today's close turning back negative all across the board, long-term, medium-term, short-term. We'll look at that chart a little bit later as we go into the wrap the week segment. The Nasdaq leading the way downwards, down 3.5% using the Nasdaq composite, the Nasdaq 100 as well. So continues to be growth, far underperforming value is really the defensive sectors the ones that were able to hold in with some sensibility through the course of the day today. Now, we have great guests coming up on the show. I had a lot of fun with some of the conversations this week. People like Sam Stovall, it's such a pleasure to be able to pick their brain a little bit and see how they're thinking about recessionary periods and all that. So make sure you go back to our previous interviews if you missed them. Next week, 3 really good guests for you. On Tuesday, the 14th, Mish Schneider, host of Mish's Market Minute on StockCharts TV and founder of Market Gauge based in New Mexico. On Wednesday, the 15th, money manager Dana Lyons from J. Lyons Fund Management will be back on the show. And then Thursday, the 16th, materials and gold expert Cliff Droke from Cabot Wealth will be joining us. Also, the Monday after next is Monday, the 20th, we'll be observing the Juneteenth holiday and taking time off from the Final Bar. Also want to let you know my next free webinar with Market Misbehavior is coming up this coming Tuesday, June 14th. We will be doing a session called the Market Bottom Checklist. Anytime I set up a webcast with this kind of title, I'm just waiting for the market to rip to the upside and completely obliterate my webcast topic. But looks like the market gods are playing nicely as we go into the weekend. I think we need a checklist to make sense of this trend and determine when the bottom is in place. So go to marketmisbehavior.com/marketbottom to sign up for that free event next Tuesday. We need to wrap this week and go to the evolution of these markets over the last 5 trading days. I did want to start with a poll, though. We always have a poll running on our live stream page at StockCharts.com, also on our mobile social media apps. So make sure you go to Twitter, Facebook, elsewhere where you do your social stuff and follow StockCharts for sure. We asked recently, which sector do you think performs better over the next 3 months? Consumer discretionary, XLY, or consumer staples, XLP? 7 out of 10 of you, 71% answered consumer staples, XLP. One of my favorite ratios to look at is the relative performance of those two groups, looking at what I call offense versus defense. And when you look at this ratio, you can see we have on the top the cap-weighted version of that ratio, those 2 ETFs that we put in the question. On the bottom, the equal-weighted version of that ratio. So it takes the overweight of Tesla and Home Depot and Amazon out of the numerator because those are pretty big names that kind of skew the results. In both cases, though, the trend has been fairly consistently down. Late March, there was a bit of a jump. This is when the S&P was trying to get above previous swing highs around 3,600, and the ratio made a new swing high just briefly for a day or two, and then rotated right back down. The equal weighted version never got up there. And really since November, these 2 ratios have been going downwards. What that means is, in general, investors have been more on the defensive side, looking at the consumer space. And to put it another way, investing in things you need versus things you want. That's a sign of a defensive market, and investors not putting the offense on the table. And again, a day like today sort of is an exclamation point to that sort of poll question. Let's continue on today's Wrap the Week segment by looking at what I call the Wrap the Week chart. It's just looking at the 5-day return starting last Friday to where we finished the market close today. In black, if you follow my voice and the mouse, you'll see what is what. At the bottom here, almost to the bottom, is the S&P 500. Not a great week for stocks. As of yesterday, it was hanging in there down 2 to 3% or so, but today really put the downtrend, I think, in confirmation, I would argue. Down 5% for the week, which is one of the worst weeks we've seen, certainly in 2022, but on average, that's a pretty fairly weak performance for the S&P 500. Only one of the things we track here in terms of the major ETFs and indexes underperformed the S&P. That was the Nasdaq 100, down 5.7%. Everything else outperformed the S&P. In purple, we have small caps, the Russell 2000 ETF, which is down 4.25%. Emerging markets, Bitcoin and bond prices all clustered around 2% down for the week. So very similar levels there. In brown, we have crude oil prices up 0.7%, gold up 1.1%, and the big winner is the dollar index up almost 2%. So when we've talked about that challenge of a stronger dollar environment, what that tends to mean. So in general, stronger dollar tends to mean stronger U.S. versus non-U.S. stocks, and tends to mean stronger small caps versus large caps. And you can see that in general, that's sort of how this week has kind of played out here. However, that strong dollar environment is one of the key themes, I think, of 2022. Very different than what we saw in 2021, and certainly something to pay attention to. Interesting that gold and the dollar were both up today, which is actually sort of unusual. If you look at the history, in general, they tend to move inversely to one another. However, what we saw going into the end of this week, the inflation number, sort of a recognition of high inflation, and gold tends to do better in an inflation environment. It's tend to be thought of as an inflation hedge, but it hasn't really played out that well. So far in 2022, having a decent week up over 1%, outperforming the S&P by about 6%. Let's look just briefly at how today's market finished off. As I mentioned, it was sort of a rollover, a gap lower this morning. I mean, the story today was about the CPI number, and essentially, inflation at highs, right, for the historical period here. You have the Fed meeting coming up next week, and so certainly a lot of expectation that the Fed would start to take more and more aggressive action to address what you might describe as runaway inflation. And again, it should not be a surprise. We've been talking about inflationary pressures, talking about the strength in commodities. I think we've sort of been, following these trends, but, I think more and more as inflation numbers appear so strong, it gives you the sense that the Fed is trying to catch up, not that they're completely on top of it. Now, the press conference next week, I am certain Powell will make it very clear how on top of everything that the Fed certainly is, but the evidence appears to be showing something different. The VIX, by the way, bouncing up, not quite to 28, but getting above the mid-20s, which is where it was earlier this week. Interest rates pushing higher with the 10-year yield, one of the biggest movers, up to around 3.16. Now, this was below 3% just a couple of days ago, and had traded back below 3%, which is sort of an interesting pause in that uptrend in rates. Now resuming the uptrend, now approaching some of the highs we've seen over the last 5 years or so. Dollar index, as I mentioned, up about 0.8%. Commodities mixed. It was precious metals that did fine. Gold and silver both up over 1%. The rest of the commodity space, for the most part, in the red, and energy didn't have a great day either. Cryptocurrencies really rolling over to the downside. Bitcoin down 3%, Ether down 6%. Bitcoin now well below 30,000, Ether well below 2,000. These are indexes and coins that have failed to regain key resistance levels. On the sector basis, very much a defensive feel to the tape today, with consumer staples number one, followed by utilities and healthcare. This is as about of a clear rotation to defense as I could script for you. On the bottom, we have consumer discretionary, technology, both down almost 4% today. Financials as well. What's interesting is as rates are going higher, the financial sector is struggling, which is what tells you this is more about a broader risk-off sort of feel. And less about stock picking, less about allocation, and more about just get away and get in the investor fetal position, if that's a thing. Just sort of try to wait things out and stay comfortable as things go crazy around you. Worth noting, by the way, some stocks were up, and this is where I think our dashboard is super helpful. I'm looking at the S&P names that were up the most today. Newmont Mining, Cardinal Health, and then a bunch of consumer staples: Kellogg's, Hormel, Kroger, ConAgra Foods, Hershey's. This is chocolate, Comfort Foods, meats and grocery stores. That is not an offensive market. That is a market rotating to the defense. Let's finish off here and look at our Mindful Investor live chart list. This is a group of charts that I keep updated at all times on StockCharts.com. You can go to my blog, The Mindful Investor. I'm just in the process of posting an article today referring to one of the charts in my Mindful Investor live chart list, simply called The Chart, some of the key benchmarks I think you could be following in this environment. As I mentioned, our market trend model turning negative in the short term had been negative long term and medium term. The short term swinging back to the negative today after 2 weeks, flipping back bullish on the bounce that we saw. So overall, my market trend model is telling me risk off and wait until you get more evidence or some evidence of accumulation. The daily chart of the S&P just shows this beautiful rotation. I was talking with, who was on the show yesterday? I was talking with Patrick Seresna from Big Picture Trading. We had a chart kind of like this. We're looking at the daily S&P chart. He was highlighting this Fibonacci relationship. Take the March high to the May low. We bounce up about 38.2% of the way. We've stalled out. It's what we've been talking about on the show since that sort of stalling. It's sort of the digestion. And the question is, which way do we resolve? Yesterday, we resolved to the downside. So while the severity of the gap lower and the extended drop to where we closed today, almost a new closing low for the year, while that may have surprised you, hopefully the direction did not, because this was a rally, a resistance, a consolidation, and then resolving that pattern to the downside. I would argue the path of least resistance remains lower until proven otherwise. Looking at a couple measures of market breadth, you can see what I mean. The advanced decline lines for large caps, mid caps, and small caps, while not horribly negative, they're not making new lows yet, certainly not positive. They're all color-coded, sort of a neutral orange or amber color. And I think that's about right. All four of them, unfortunately, getting back below their 50-day moving average. That is not a good look if you're on the bullish side. We have a number of indexes tracking the percent of stocks above key moving averages. There are 25% of S&P members above their 200-day as of today's close, only 12% above their 50-day moving average. That is a new low for the year, one of the lowest readings you'll see if you go all the way back to the 2009 market low. Now, it's not the lowest level you're going to see. The lowest level is zero. And this is one of those times when I would encourage you to bring in more data. If you're just looking at the last couple of years, you'd say, wow, this is as low as this thing ever gets. This is an obvious buy signal. I mean, yes and no. If it was just a buy on the dip sort of environment, yes, this would be an ideal time potentially to sort of scale into the next leg higher. But look what happens during more extended bear market phases. Late 2018, where else would it be? Maybe 2015, if I remember right. Certainly 2008, 2009, when the market really gets bearish, this indicator goes to zero and stays there as pretty much everything is below its 50-day moving average. We're also seeing an evaporation in new highs and the beginnings of some new 52-week lows. So while the S&P did not quite make a new 52-week low for the year, but is within the range of those lowest days, a lot of individual names are starting to do so. Not a ton, right? So 15 out of the 500 names in the S&P 500, that's not a ton. That's like 3%, but it's a number. It's a beginning. And as these red bars would continue, that would tell me to start to be a little more and more skeptical or cautious about this overall market environment. We need to take a quick commercial break. We'll be back with our next segment, Power Up. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Listen, thanks so much for joining us every weekday after the close for our show. We very much appreciate it. A couple quick announcements before we continue on with our next segment, Power Up. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show featuring questions from viewers like you over the last couple of days. Keep your great questions coming. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air Tuesday of next week. Also, go to StockChartsTV.com. Our StockCharts TV team has done such a fantastic job creating Fantastic content every trading day. There's so much great stuff on there. Larry Williams today, a market outlook just last week. We've had recent episodes of The Pitch, even our stock picking exercises like our stock charts draft, which occurred back in April, all on demand, along with some great documentary work as well, award-winning documentaries at stockchartstv.com. Also on your mobile device, just search for Stock Charts TV on demand. Let's continue on the show with our next segment, Power Up. What we like to do every Friday is just give you just an inkling. It's a couple ideas of how to use our Stock Charts platform a little better. You know, working with this platform intimately over the last couple of years, I will tell you there are a lot of really cool features embedded in Stock Charts, and it's just a question of getting comfortable with the capabilities of the platform. On your dashboard, and when you join as a member, you have access to a really cool customizable dashboard that allows you to really bring all the most important stuff that you want to follow right in front of you. And in the upper right, you have this button called ChartLists. Now, most of our shows, and certainly mine, I'm using ChartLists all the time. So anytime you see me bring up some charts, look at a candle glance page, or flip through and sort of do a chart book thing, sort of flip through one chart at a time, that's all using our ChartList functionality, which is basically taking a group of charts, putting them together in a meaningful way. What I want to talk about just briefly today is how to organize your chart list. Now, this is a trick I've learned from people like Grayson Rose, Greg Schnell, Tom Bowley, Arthur Hill. These guys are experts at organizing a ton of charts, hundreds, if not thousands of charts in a way that they can use. Grayson, I was just talking with him earlier today. He has a great regular daily and weekly process, all driven by chart lists, and he has the ability to go through. He organizes them in a very aggressive and very powerful way. I'm sort of the light version, and I'll show you how I got started. The trick with chart lists is to use symbols and numbers at the beginning of your chart list. So number one, make it a meaningful name you're going to remember. So the chart list I use most often every single day is what I just call random social media charts. I create something, I want to post it on Twitter or LinkedIn, and I just want to save it somewhere so I can always go back to it. You can see I almost have 500 charts in this list. So I have these 2 exclamation points so that it's always at the top of my list of chart lists, because that's what I hit often. So I create a chart, I save it to that list, and I can post it places. Then I can always go back and see what charts I've posted before. Then these are the other lists that I use regularly. My Mindful Investor Live chart list, the 3 and 3 that I feature on the show every day. When I go on other media like Bloomberg Television or something, I save the chart that I talk about there. And then anytime we have a guest coming through and I need to help them customize their chart, I put it in that Final Bar Guests folder. After that, I have it organized by big picture equity charts, breadth sentiment indicators, sectors, and individual themes and groups, and then a bunch of random lists like cannabis stocks, recent IPOs, fan mag names, and so forth. So if you look, the reason why they're in this order is because I have used symbols and numbers to put them in a very specific order. And I do that so that I can always move them around very easily. ACP, I can access the same list of charts and do it. So what I would encourage you with our chart list feature, number one, just start saving charts into your list, but use symbols and numbers at the beginning to put them in a meaningful order. Always get the most important ones at the top of your list. Let's continue on with our Final Bar mailbag. As a reminder, our email is thefinalbar@stockcharts.com. Keep your great questions coming. And here's question number 1. At what point do you need to be concerned with the XLE pulling way above the 50-day moving average? Is it better to wait for a pullback to the 50-day or just get in because the trend is up? And I get a lot of questions along these lines talking about, charts that are in strong trends. Where is the right time to be doing it? And it's hard to really answer that question because it depends a lot on your investment style. I will tell you the style of investing that I'm essentially portraying on this show every day and every week is what I would call trend following or momentum investing. My goal isn't to pick the bottom. I think that's a very challenging and not particularly helpful approach because it's very difficult to do. In the rearview mirror, we often think with perfect hindsight that we knew the ideal time to buy or sell. In reality, most accounts never look that perfect. It's hard to pick a bottom as it's happening. It's very easy to recognize a bottom after it's happened and see how things have changed. So I am much more comfortable as a trend follower, looking for long-term strength and short-term weakness. So the ideal chart for someone like me would be the XLE, kind of late April, early May, which is a strong long-term trend. The momentum pulling back, the RSI pulling back to about 40, the ETF or the stock pulling back to the 50-day. That combines what the data has shown is a very profitable system for investing in equities, looking for strong trends where in the short term, there's been a little bit of weakness, allows you to get in very easily because there's plenty of supply, there's plenty of selling going on, but overall you remain in an uptrend. You're able to essentially buy on the dip. So that would be my thing to encourage you at with a chart like the XLE. Yes, when I talk about how energy is working, I'm never really saying at this moment, this might be the right time. That really depends on you and yourself. Some people are very comfortable buying new highs. Some people wait for pullbacks. Some people scale in or out of positions. And that's why investing can be a very individualistic exercise. In general, though, I like to highlight strong trends. And tactically, I would always look for better pullbacks as an opportunity to scale into a chart like the XLE in a nice uptrend. Next question. If enough people sell growth and buy value, don't the value names no longer become value names? I love this one. I know there's a pure growth and pure value, but after some point, isn't it like running from one end of the Titanic to another? I mean, if the ship is sinking, it's sinking, right? So, I mean, yeah, it's a very good question. The answer is no. And what's funny is if you look at growth stocks, you would think, okay, growth is coming down so much, so the valuations are probably coming down so much as well, right? And sorry, as I'm talking, I'm trying to bring up a chart here of growth versus value. You mentioned like the pure growth and pure value indexes, and that's this one. So this line going down means basically value has been dramatically outperforming growth really since late November of last year. Here's the thing, as growth stocks have come down, the valuations really haven't come down a ton because the earnings have been declining as well, right? These are a lot of companies that don't earn anything, and the ones that do are earning less. They're having their estimate, they're dialing down their estimates, they're bringing down their earnings. So if price and earnings both come down, the PE ratio remains kind of stable. So it's not like valuations are getting way bombed out and way low. The market arguably is not too much overvalued or undervalued relative to what it was 6 to 12 months ago. I would argue it's probably relatively stable given how much earnings have started to really deteriorate. So the answer is no. Value names are less about the fact that they're particularly trading at a cheap valuation right now. It's more about the style of names. It's names that generally have the characteristics of value companies. These are more established companies, ones that tend to pay a higher dividend, ones that are more, looking for, slow and consistent growth in their business as opposed to the explosive growth that you might get from a growth company, an emerging growth name, for example. So no, we've done nowhere near enough of a change in this market over the last 6 months to really change the labeling of most value and growth stocks. I would say it's way more stable than you probably might expect. Next question, can you somehow rationalize and predict the move that LPI just did? And I love a question like this. I'll do my best. It seems to be pretty implausible considering its setup to be able to predict and catch such a move just based on technical analysis. So this is LPI, and I'm wondering what move you're talking about. I'm guessing maybe we look at the last year or something. I guess maybe this move right here is what we're talking about. So I often get this kind of question, how could you have known that was that? Did you see that coming and how? So I will tell you that in investing, nothing is known for sure. No one knows what's going to happen tomorrow. And anytime someone like me pounds the table and says, the market is going down, I always cringe a little bit because is and must and will and absolutely, those are dangerous words in investing because all sorts of random stuff can happen. It doesn't matter if you were using technical analysis or fundamental analysis or a quantitative model. The market has what are called fat tails, right? A normal distribution of kind of the average returns that a distribution of a currency should have is sort of a bell curve. The markets have not a bell curve. It's like a bell curve with really high ends to it because sort of 3, 4, 5 standard deviation move happens way more often with the equity markets than they would in a traditional normal distribution. That's what they call the fat tail effect with equity. So the challenge is you often have these sort of black swan events, these crazy things that happen, and news flow will often come in when you're looking at a stocks and surprise everything. So charts can't predict the future. I wish they could in some ways, but they can't. All we can do is make educated guesses about what's going to happen based on our understanding of market dynamics, our awareness of market history, and just appreciation for the general market cycle that we're in. So having said that, what could you be using to identify this sort of move? Well, it depends on what you're trying to do. And what I would say if you're looking at this chart is where would you really want to buy this? Like, yeah, ideally, I'd love to buy it at 55, but that's a really hard thing to do. If you would want to do that, I would be looking for indicators like RSI, which became oversold, something like MACD probably turned positive or PPO turned positive once it had recovered. I'm probably more looking at a chart like LPI when it's breaking to new swing highs, getting above 90. So my toolkit, trying to capture this type of chart, I have a screen of stocks making new 3-month highs and stocks making new 3-month lows. I refer to them regularly every trading week, and it's designed to capture charts like this. And these are the types of names that I'm able to identify because I'm always looking within a big universe of stocks which names are breaking out to the upside and which ones are breaking down to the downside. What I would encourage you to do, this is exercise I've done with money managers, is look at the chart and circle where you think you would really like to buy this, right? Are you really trying to capture the low? I think that's really hard, but give it a shot. Are you really more looking for breakouts? And then look at technical indicators, look at technical approaches that would have confirmed that point, right? Sort of pick your ideal entry point, then look at what indicators, sort of back into what techniques would have helped you validate that that was an appropriate time to buy. Then start to run screens and things to look for similar names and see if it helps you identify a workable list of stocks and a workable list of charts that you can play around with. Final question, then we have to wrap this segment. What consideration would you make to incorporate inverse ETFs as part of a portfolio to manage risk and increase the probability of realizing gains during a market downturn? That's a really, really good question. And I think there can be a place for inverse ETFs as long as you're aware of the risks and you understand the exposure you're actually getting. I think people get into trouble with inverse ETFs and leverage ETFs when something happens in the market, their ETF does something and they're sort of not really familiar with it. A classic example is over time in certain environments, the longer term percentage returns in a leverage ETF in an inverse ETF can become a bit disconnected from the actual returns of the underlying index just because of the way that they're calculated and liquidity issues and all those sorts of things. So I did put a video on my YouTube channel, probably a couple months ago, particularly looking at inverse ETFs and some of the challenges structurally with those. I'd encourage you to go to my market misbehavior channel and watch that. So that would be my thought is number one, understand the risk. Think about how you're sizing that sort of exposure relative to other things. But, very basically in this sort of environment, if you have a strong conviction the market is going lower, I'd have no problem using inverse ETFs. I've certainly used them at times in my personal account to gain exposure because I don't short stocks, and that's an easily, relatively inexpensive way to get short exposure in a particular theme or group. Great questions, you guys. Thanks so much, and please keep them coming. We need to wrap today's show, though, and go to the 3 and 3. Let's break down 3 charts in just under 3 minutes that make sense of this market. Number one, my market trend model. I've done a number of comments on this and just posted a video on my YouTube channel maybe a month ago, a couple weeks ago, talking about the most important chart of the day. And it's basically the first one you look at. This chart right here is the very first chart I look at every trading day. And it's so I can remember the long-term, medium-term, and short-term trends and make sure I appreciate the trajectory of each one of those. By the way, this just did indeed turn negative. I didn't have a chance to tweak the label before we started the show, but long-term, medium-term, short-term trends, as far as I'm seeing it in the charts, are negative. That tells me to be cautious, to be in cash or cash-like things, to be defensive, participate in upward moves as they happen, but not be aggressively looking for new opportunities until the model starts to change. Chart number 2 is looking at market breadth in the form of stocks above or below their moving averages. This is one of those dangerous times where if you look at this chart for the last 2 years and say, all right, 25% of S&P names above their 200-day, that's the lowest reading in the history of this chart, this brief 2-year history. Only 12% of S&P members above their 50-day, that's the lowest reading over the last 2 years. Obviously, a weakest point, that should be a buy opportunity, right? And buy on weakness. Not necessarily, and that's the problem. If you look back to previous market bottoms, and that's where I would bring in a lot more data on a chart like this and look back to 2020 to 2018 to 2015, 2016 to 2008, 2009. These are the major pullbacks, even back to 01 and 02, and see what these indexes actually did. And what you'll find to save you the task of doing that is these indicators can both go all the way down to 0 and just sit there. If I remember right, 2008, 2009, the percent above their 50-day got down to 0%, stayed there for probably 4, 5, even 6 months. So keep an eye out for something like that. Finally, Newmont Mining. I've highlighted some candle charts recently. I've been really into these. Newmont Mining, a bullish engulfing pattern right at the 200-day moving average, maybe an interesting opportunity for a bounce going into next week in a group gold that has not been done particularly well. That's a wrap for this week. Thank you so much for joining us on the Final Bar. All of our previous interviews and episodes at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.